All right, we're live with another FOMC forecast and another FOMC coverage. So where are we at the moment? The FOMC's published their minutes. Fed leaves rate unchanged. So the interest rate, of course, unchanged. We knew that was going to happen. They say the uncertainty has diminished, but it's still elevated. They lower their GDP estimate to 1.4%. So they're expecting the economy to slow down. And interestingly, they are expecting the interest rates to actually go up, the inflation rates to actually go up. They're talking about inflation at 3%. Bear in mind, inflation now is at about 2.4%. And the dot plot, which is the big thing that we were actually looking out for, here it is. This is the dot plot. The dot plot still shows that the Fed officials still believe that there are going to be 2 rate cuts this year. So pretty much no change in the FOMC. We're going to be covering FOMC. We're going to be covering the Genius Act. We're going to be covering the war. We're going to have Sheldon trading with us. We're going to have Nick from Lady of Crypto or Lab of Crypto joining us. We're going to be locked in and loaded. Lots to talk about today. So if that sounds good to you, you know what to do. Obliterate the like button. Let's go. Okay, I'm looking at the Bitcoin chart. Not much movement. 104,263. But the one chart that is, I'm not going to say worrying me a little bit, but you know, I drew this trend line in the oil chart, and I said, if oil goes above this trend line, then you kind of know that something is going to be that the world's expecting some kind of escalation. And I mean, right now, oil's at a very, very, very key point. You can see that oil is on the trend line at 75,315. Oil is very, very, very much on that trend line. Why? Let's cover it quickly and before we get into the actual FOMC meeting. So what's going on here? There was some escalation. So the US, you could say, kind of threatened to join the war. That was yesterday. Trump basically came out and says we have total control of the skies over Iran. Iran had a good sky trackers and other defensive equipment and plenty of it, but doesn't compare to the American-made, conceived, and manufactured stuff. Nobody does it better than the United States. He then told Khomeini, we know exactly where you are. We're not going to kill him just yet, at least not for now. But we don't want a missile shot at American civilians or American soldiers. Our patience is wearing thin. He says he should have taken the deal. He said Khomeini should have taken the deal. And then Khomeini responded, and he said the harm of the US will suffer will definitely be irreparable if they enter this war. He says the US president threatens us with his absurd rhetoric. He demands that the Iranian people surrender to him. They should make threats against those who are afraid of being threatened. The Iranian nation isn't frightened. Someone actually tweeted below this and said, "Come, step out the bunker and say exactly the same thing." You probably wouldn't do that. So there have been some escalations in the war. The major escalation, I think, is around the Strait of Hormuz, which is, remember, it's a very small area of land, of sea, where all the oil, or 20% of the world's oil, actually flows through. So all the oil in that region flows through a thing called the Strait of Hormuz. Now, the reason why the oil price spiked today is because of this tweet over here, where it says, former Iranian economic minister declared that starting tomorrow, all oil tankers and LNG shipments will need Tehran's approval to pass through the Strait of Hormuz, the world's most vital oil choke point. The policy set for 100 days aims to end Trump pressure campaign through economic security and measures. So that's why the oil prices are going up, and that's why the oil prices are tapping this what I've called the war line. I mean, it's a 2-year downtrend of oil. And you can see that we're very, very, very much. And if we break up above the war line, then I think that the world believes that the escalations are real. If not, I don't really think so. I think interesting interesting to note, if you look at the war. So the war is between Israel and Iran. Iran's pretty much being brought to its knees, right? And if you look at Israel, look at their stock market. So this is the Israeli stock market. Look at these green candles since the attack. So if you look at the daily candles since the attack, which is about here, the Israeli stock market is about up 7% on the Iranian attack. And I think the reason for this is because Iran's been such a cloud over Israeli prosperity. And always, like, you always think like Iran's always threatened to bomb Israel and to remove Israel from the world, etc., etc. That now that this threat is being neutralized, the Israeli markets are actually at all-time highs. Just look at this. That's the Tel Aviv 35 index, which is, I think, the key Tel Aviv index. I must say, I hadn't been following this until recently. One of our researchers actually brought it up. But you can see even like the TA35 is up 9% since the invasions in Iran began. 9%. That's a massive, massive, massive number. So, yeah, I mean, interesting to know. Look, we are keeping ahead of everything that's abreast of everything that's happening in the Middle East. Let's talk more about the FOMC, because I guess that's why we're here. So my big concern around FOMC was around the dot plot. And the dot plot was, the reason why I was concerned is because you had the Fed whisperer, a guy called 𝗦𝗡𝗏. And he basically said, look, he said if it wasn't for the tariffs, then probably Powell could have actually cut rates. But he also, I think he warned of a dot plot that may be a bit negative. So let's just have a look here. I want to try and find this for you. They call this guy the Fed whisperer. He said here, is the Fed losing the plot with its dots? Consider at June 2024, the median projection moved from 325 basis point rate cuts to 1. Then the Fed delivered 4 cuts worth of easing. So basically, he was questioning whether or not this dot plot is actually as accurate as it used to be, or as important as it used to be. So what we got a dot plot. The dot plot, it's ever so slightly changed. Like, I think he actually tweeted it. Let me see if I can find that tweet for you. Yeah, it's ever so slightly changed, but the median projection is that there's still going to be 2 rate cuts this year. So the question is, when are these rate cuts actually going to happen? So let's just quickly look at the rate cut expectations here on CME. So let's just let me actually make this a bit smaller so that you guys can actually see it. There we go. So let's look at the probabilities. Now, I'm not sure how updated this is. So let's just quickly refresh this. There we go. It's refreshing. The next FOMC meeting is in 41 days. That's the 30th of July. There's July, September, October, December. There's 4 more meetings. So what the Fed officials are telling you is that in 2 of those 4 meetings, we're going to get 25 basis point rate cuts, all else being equal right now. So they're saying, look, there's 30th of July, September, October, and December, and they're saying 2 more rate cuts. So the question is, when are these rate cuts actually going to happen? So one could happen, you see, they're saying in July, no rate cut. So the next rate cut actually is September, and then the last one in December. That's what the markets are pretty much telling you. So, I mean, really no big change there. I mean, this is quite bullish bearish. So when I say bullish bearish, slower economy, good for the Fed for cutting. So they were saying Fed lowers GDP estimate. They're predicting a slower economy, but they lift the inflation target to 3%. That's crazy. That means that they're seeing inflation actually going to spike, believe it or not. Let's quickly just see what investing.com, what the actual inflation numbers actually are here. I think it's this one over here. Let's have a look. 3. Okay, so no, that's Japan. I was about to say that looks crazy. Investing.com. Let's go here. And there we go. Calendar CPI. I think this is US CPI. Yeah, this is US CPI. So currently inflation 2.4%. So they're forecasting that inflation is going to go up to 3%. But in my inbox, which I'm looking at now, I've got a inflation report from Trueflation. Very good people just sent me the inflation report. You see, they watch the show here. The guys from Trueflation definitely watch the show here. So here's the inflation report from Trueflation. That was the May inflation report. Inflation forecast 2.4% from May. That was correct. I remember that. I wonder if they give you an inflation for the end of the year target. Let's see. Is there an inflation at the end of the year target? Stefan, I know you're watching. So if you're watching, just let me know. Is there a target here? Because unfortunately, I don't really have time to dig in through all of this. So 2025. Okay, so this is all historical. Okay, so we're waiting for Powell to go live. Obviously, we have got the tab open right here. We've got the tab open. Waiting for Powell to go live. Sheldon is joining us. Nick is joining us. Nick, our good friend from Lab of Crypto, he's joining us. Let's actually... Oh, how do we end this? Hold on a second. Hold on, I have to try and get rid of this inflation report because I opened it as a preview, and now it is destroying my WhatsApp. Okay, let's close that quickly. Let's close that preview. Let's have a look here. Let's see what else is coming out here. Let's have a look here. All right, so 7 Fed members. Here we go. So let's quickly just look at what the Fed members are actually thinking. 7 Fed members, 7 members of the Fed now pencil in 0 rate cuts for 2025. Holy shit. There's 19. There's 19 people in the Fed. 19 and 7. So let's actually go to the dot plot. Here is our dot plot over here. Actually, we can look at it over here. It's much better. So 7 say no rate cut. That's 1, 2, 3, 4, 5, 6, 7. Say no rate cut. 2 say there's going to be 1 rate cut. 1, 2, 3, 4, 5, 6, 7, 8. Okay, it's very close. It's very, very close. You're basically saying 7 say no rate cut. 2 say 1 rate cut. 2 say 3 rate cuts. And 8 say 2 rate cuts. So it's very torn actually between no rate cuts. If you think about it, no rate cuts and 2 rate cuts is like the consensus vote. So like, and these two are Trump's friends. The bottom ones here are Trump friends. I don't know if you guys saw earlier, but Trump basically said he wanted to appoint himself as the chairman of the Fed. It was actually very funny. I mean, it would probably be worth listening to this.
It's a shame. This guy, do you ever have a guy that's not a smart person and you're dealing with him and you have to deal? He's not a smart guy. He's worried about inflation. I said, that's right. If there's inflation in 6 months or 9 months, you lower the rates or you raise the rates. You can do whatever you want, Brian, right? So let's say there's rampant inflation, which there's none. You know what there is? There's success. I got a call from Congress last night. Sir, there's a problem. I said, what is it? Money is pouring in. We don't know how to account for it. I said, check the tariffs. $88 billion came in from tariffs. No inflation. And it's going to get even more so. I know what I'm doing. So we have a stupid person, frankly, at the Fed. He probably won't cut today. Europe had 10 cuts, and we had none. And I guess he's a political guy. I don't know. He's a political guy who's not a smart person, but he's costing the country a fortune. So what I'm going to do is, he gets out in about 9 months. He gets fortunately terminated. Biden, I would have never reappointed him. Biden reappointed him. I don't know why that is, but I guess maybe he was a Democrat. I got great advice from Mnuchin on this one. Great advice. But he's done a poor job. So we have no inflation. We have only success. And I'd like to see interest rates get down. Now, Biden did a lot of very short-term debt. So we have short-term debt coming due. And because of this guy's rates, if he'd lowered a point, I'd pay about a point less. Then if he'd lowered 2 points, I'd pay about 2 points less. And that's for 10 years, 12 years, 15 years, 5 years. It's hundreds of billions.
He's right.
Even trillions.
In this case, Trump is very, very right.
That we're going to lose because of this too late. I call him too late Powell because he's always too late. I mean, if you look at him, every time I did this, I was right 100%. He was wrong. Maybe I should go to the Fed. Am I allowed to appoint myself, Doug? I don't know. Am I allowed to appoint myself at the Fed? I do a much better job than these people. So anyway, we should be 2 points lower.
Actually, wait, I want to go get something. Hold on.
We'd be saving $800 billion, $700 billion. That's a lot of money. Right? Think of it for nothing, for absolutely nothing. We'd save $600, $700, $800 billion. We have, I think we're 38th now in interest, and we should be number 1. We should be the lowest. But, and by the way, if he's worried about inflation, that's okay. I understand that. I don't think there's going to be any. So far, there hasn't. I mean, we have almost no inflation. We've done a great job. When I came in, we had a lot of inflation. We went through 4 years of the highest inflation in the history of our country with Sleepy Joe Biden. And Sleepy Joe. And he didn't know what the hell he was doing. And so we had the highest inflation we've ever had in the history of our country. And then it came down because when I got elected, it started dropping because people understood that I knew what I was doing. But now we have a man that just refuses to lower the Fed.
Same, bro.
Just refuses to do it. And he's not a smart person. I don't even think he's that political. I think he hates me, but that's okay. He should. He should. I call him every name in the book, trying to get him to do something. I've been nice to him. I do it always. I don't know.
Ask him for dinner.
I've been so nice to him, fellas, you wouldn't believe. Let's have dinner. Too late. I call him too late. Come on, too late. Let's have dinner. I do it every way in the book. I'm nasty. I'm nice. Nothing works. He's like just.
Look at this guy's face.
Person.
Look at the guy's face behind him. Look at this guy. This guy here. He can't keep a straight face. Just He must be a Democrat, okay? Now, just watch this guy's face. We've got to go a little bit back.
I don't expect anything. Let's have dinner.
The guy can't keep a straight face.
I'm nasty. I'm nice. Nothing works. He's like just a stupid person. But I don't expect anything. Maybe he does
bro's about to burst out laughing.
Remember, Europe had 10 cuts. We had none.
This guy here looks a little bit like BitBoy. Like if BitBoy was a construction worker, that would be BitBoy, right?
We're paying more rate, more interest than a lot of European nations that
I mean, this guy's definitely BitBoy. Look at that. Is that not BitBoy? Like that guy's BitBoy's uncle.
Can't carry our suitcase. I'm going to be nice. It's another expression. You know what the other expression, can't carry your, you know what it is, but I shouldn't use it in front of the
There's BitBoy laughing, bro.
So it's very sad to see it. And what I'm going to do is I'm going to go very short term, like 6 months, 7 months, 8 months. Wait till this guy gets out, get the rates way down, and then go long term. Because we have...
See, so what Trump's basically saying is he's going to finance the debt short term, like basically pay the high interest rate short term, and then wait for Powell, and then get someone else in there who's going to reduce rates like a lot, and then refinance the debt.
A tremendous appetite for our debt because our country is doing well. But think of it, I got a call from Congress 3 nights ago. Sir, we can't account for the money coming in. I said, that's a good problem. You know, the bad problem is we don't have any money. They can't account. There's so much more money than we thought is coming into the Treasury. We don't know where it's coming from, sir. I said, check out the tariffs. He calls back about a day later. Wow. I think you were right. Yeah, I was right. That's nothing. You haven't seen anything yet. More importantly than the money coming in.
What do you think? Let me know in the chat. Do you think Trump's going to get involved in this Israel war or not? What do you think? What is the general consensus? I did see another story today around the Fed, and they're having a meeting on the 25th of June, which is about exactly a week from now. Now, what this meeting is about is it's about something that really could bring more money into the economy, and it's a good thing. This is a very, very, very good thing. So, what is it about? It's about what they call the supplementary leverage ratio. For those of you who don't know what the supplementary leverage ratio is, it is designed to make the banks stronger. And basically what it says is, it says banks have got to have a minimum of what they call tier 1 capital on their balance sheet. So large banks currently need to have tier 1 capital, such as common equity and retained earnings, which can quickly be liquidated or absorb unexpected losses, equivalent to 3% of their assets. For the large institutions, which are entwined with the financial system, they've got to have 5%. Now, there is I don't know if it's a rumor. I mean, we know for sure that this is happening. There is a proposal that would lower the bank holding company capital requirement to a range of between 3.5 and 4.5%. What that would mean is that there'd be more capital freed up and more money in circulation. So if the Fed is not cutting, then if the Fed's not cutting interest rates, this is another way to actually get money into the system. Remember, we're going to have Powell speaking in about 5 minutes. We want to hear what he says. He's probably not going to say much about like interest rates and inflation. He's probably going to say, look, you know, the tariffs are giving us uncertainty and whatever else. He may even mention this Iran war and oil prices and all that. And then he'll probably indicate something about quantitative easing versus quantitative tightening. So yeah, we'll listen to what he has to say. He'll be on in 4 minutes. I mean, I'm sure I'm sure you saw this already, but in case you haven't, the Genius Act actually passed the Senate yesterday, which is great for crypto, great for stablecoins. It's like a watershed moment. As Jerome Powell says, he says history is being made in the Senate as the US passes the Senate Genius Act, taking us one step closer to breakthrough legislation being signed into law that will drive US economic prosperity and competitiveness. I mean, just look at the Circle share price on that act being passed. Circle, which came onto the market and expected to get a $6 billion valuation on the markets, is now trading at $40 billion. They were looking at selling to Ripple or selling to, I think it was Coinbase, for like $11 billion. This thing's priced by the market at $40 billion. Can you believe it? $40 billion. That is like insane. It's absurd. I must say, I think it's too high. I mean, one of our analysts here, he's what do you say? He said he's long Coinbase, short Circle. I don't know if it's the smartest trade, but I mean, yeah, maybe it is. Let's see what Coinbase is actually doing on the news of that. Let's see what Coinbase is doing. Holy shit. God candle from Coinbase. Look at this. God candle. God candle. You know why? Because Coinbase have a distribution agreement with Circle. So they like Coinbase distribute the USDC for Circle, and they get like the majority of the profit actually goes to Coinbase. I'm just looking to see what's coming out on the tickers. Okay. Let's see what else. Let's look at the bubbles. So Aerodrome flying. Why is Aerodrome flying? Because Coinbase is flying. You remember, this is one of the in front runners. I gave 3 calls. One was 𝗬𝗎, not doing as well as I want. Aerodrome was the other one, and 𝗕𝗏 was the third one. Those were my 3 calls. I'm playing the Solana narrative. I'm playing my call on 𝗕𝗏 was at 180. I'm playing the Solana narrative. I'm playing the stablecoin narrative. I'm playing the ETH narrative. I reckon that's what's actually happening. Okay, more coming through. Fed's forecast is stagflationary. Let's have a look here. That just came into the wires now. Fed's forecast is stagflationary. Growth revised lower in 2025, 1.4 from 1.7, and 2026, 1.6 to 1.8. Unemployment revised higher. So the Fed is now, their base case is actually stagflation. Holy shit. That's not good. Fed's forecast is now stagflationary. Holy moly. So the Fed's forecast is genuinely now stagflationary. Our friends joining us today. Like we should have Sheldon coming. Nick should be coming.
Nick is here.
They promised us we're going to have a party. Where's Sheldon? Where's Nick? Where are my friends?
Nick is here.
Is Nick here? Let's get Nick on, man.
Nick just arrived.
Oh, he just arrived. Yo, what's up? You know, I don't, come on. I don't hear Nick again. How do I not hear Nick again? No. Nick, are you not muted? It's impossible. How do I? Last time we also didn't hear Nick.
He's muted.
You muted. The system says you muted, sir. He says no. Okay, Hardest, will you guys sort this out while we got to get Nick on. Come on. We can't not get Nick on again. Last time we had the same issue.
Hear me now?
Oh, now we hear you.
I changed my microphone, but it's using this mic, not my fancy mic. I don't know if you can hear me properly, but
All right, let's just get the Fed stream up because Jerome Powell's almost here. Let's really get everything. And we see Nick twice. You see, I can see Nick twice. Okay, Powell's here. Okay, let's go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position.
Keep saying the same thing over
The
and over
unemployment
and
rate
over.
remains low
What happened?
or near maximum employment, but has been run longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal.
Oh, come on, it's 2.4%.
Estimates
bro.
based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026
Someone
and
says, what color is the tie? Usually it's
2.1% in
purple, you said.
2027.
Purple, it is purple.
Our
It's the mix
monetary
between
policy
blue and
actions
green.
are guided by
Blue
our
and
dual
red.
mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored.
Short-lived or short-lived?
Our
Let me know in the
obligation is to
chat.
keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from
What
becoming an
hat are you
ongoing
wearing,
inflation
bro?
problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based
Dot
on
plot,
what
the
each
dot plot.
participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay, so let me know in the chat, is it short-lived or short-lived, guys?
Thank you. Colby Smith with the New York Times.
Can you hear me?
To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts?
Because
or is it about responding to a deterioration in economic activity, let's say? I mean, how should we
7 people said no rate cuts, and 8 people said there would be rate cuts. There may not be rate cuts.
And to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chairperson Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjusted over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term as you get out to the later years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here, since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said
Good
was
question.
that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over by
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
𝗙𝗪𝗡.
Thank you. 𝗙𝗪𝗡 at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back at to roughly 2% despite the tariffs. And I guess I also wanted to ask about, cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5–2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very slow continued cooling, but nothing that's troubling at this time. But we watch it very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe
Not much
for us
news
some of
there,
those
guys.
scenarios.
Like
How
it's
do you
quite-
get to a place? I'm noticing that the uncertainty levels in your forecast are very high.
Yeah, not much.
How do you get to a place where you have the confidence in the outlook for, say, inflation and/or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see whether, to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and it's a pretty,
Basically,
I think all
he's saying
estimates
if
are
there were
now
no
pretty
tariffs,
close
there'd be
together.
interest rate cuts. That's basically
it's
what he's saying.
highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook, or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts. And they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So
He's basically saying the dot plot's
that's really
like
where
nothing.
it is. It's
No
a
one
function
holds
of
the
those
rate
things.
path.
And I
We don't
think
know
as
what's
the
going
data
on.
come
There's
in, you should see
uncertainty.
those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not, we have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't, we have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Mr. McKee.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme
That's
Court
Trump,
has
obviously.
maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers about the outlook for the economy.
Look, from my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with a strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Thanks, Mr. Chairman. I guess with workplace raids picking up significantly, what kind of effect would that have on the labor market?
I think they're pretty much going around in circles now. Nick, what do you think, sir?
Well, uncertainty is the worst thing for markets, isn't it? I don't think it's good for crypto, especially for altcoins. I mean, altcoins are risk assets, high risk assets, and when it comes to high risk assets, no one's going to want to buy them in periods of uncertainty. So it's not looking very bullish to me. Also, stagflation is just horrible. It's one of the worst things you can get for markets.
The Fed can't fix the Fed can't fix stagflation. They don't have tools to fix stagflation. One thing I am watching, guys, Sheldon, I don't know if you're watching this, but I'm watching this chart over here, which is the oil chart. So to me, none of this FOMC shit matters, bro. It's all about the oil price. So you can see oil back up at the trend line now, and then all the other risk assets have been going down. So Bitcoin going down, altcoins going down. Literally everything's following the oil price. I drew this line over here. I called this line the war line. This is like the downward oil price, the downward trend of the oil price since 2022. And you can see that right now we're back on, it was at 71 and 72, and now we're back at 75. It's like, to me, like everything's about the Middle East now. Everything's about the oil price now.
Yeah, you can see it clear, bro.
If America
and it's crazy how that chart's showing us, because a breakthrough that is showing quite a big
Can they not hear each other? Hold on.
We can't.
You can't hear. I can't believe we have the same
I can't hear
problem.
Sheldon. Sorry if I was speaking.
I can't hear
I
Nick.
couldn't hear you.
I can't hear Nick.
How did we get into the same position again? For God's sake. Sheldon, tell me what you're thinking, sir.
No, that chart, we don't want that chart to break, sir. That's another huge increase. I actually have it here. Let me just see here.
Do you know you share a screen on the system? I saw your eyes wondering. What were you watching? Because you weren't watching the Fed charts, bro. I saw your eyes wondering early on. Hold on.
I'm getting ready for longs, sir. On
longs. I agree.
You know, today's a big day for me. Like today's, I've been building this indicator of mine, and it's finally working, and it's finally launched and finally ready for myself.
Just show me. Just show me. Can you share your screen? You know how to share your screen. Nick, you can hear me, right? Nick can hear me. Thumbs up if you can hear me, sir.
I can hear you, yeah.
But you can't hear Sheldon.
I'm playing it live on YouTube, so I'm unmuting whenever he talks and trying to mute when he talks.
It's hard. We've got to fix this shit, bro. Yeah, they're going to try and fix it so you guys can hear each other. I can't believe we're having the same problem again. Anyway, but let's see, Sheldino, when you know how to share your screen, let me know.
It says it's shared.
Okay, so let me try and share. There we go. I can see it. Okay, so tell me okay, I see your indicator. I'm very upset with you about this indicator. Like, it's the first time in my life that I've ever seen an indicator where the guy doesn't sell it. You can't use it. Basically, the guy just has an indicator and he just keeps it for himself. Like, it's not on, bro.
I'll share it with you, but you can't share it though. This is like something I've been working on for some time, sir. But this thing's basically saying here that, we're going to come sweep these little lows here.
Yes.
Which is this early 140s like on Solana. And I'm going for Sol. I've been looking at Solana to Bitcoin, pairing Solana to ETH. Sol's looking very strong. And I don't see much lower. I'm looking at Bitcoin. There's a bunch of support sitting here at this 103 as well. So I think this is a quick little dip off. And then from here, I'm looking for some longs for the markets. And I'm actually trading a little bit higher time frames. I'm not trading small time frames, 4 hour, 8 hour, 12 hours. And then I'm going to be buying the dip, sir.
So look, so that makes a lot of... Oh, wait, someone's echoing.
𝗏𝗏𝗏 is here.
Yeah, someone...
Okay, now I've muted.
Yeah, no, so I'm hearing it myself in my ear. So whatever you've done, change it.
I can hear 𝗏𝗏𝗏.
I don't know what you guys can hear. Anyway, what I'm seeing here is I'm seeing the oil price here rejecting off this line. And if it does reject off this line, then your longs will actually play out exactly like you said.
Yeah. Well, what is the ticker for oil? Let me see what the indicator says.
The one that I'm using is Brent, BRENT, Brent.
Let's see if the indicator works on this thing. I've never tried it with something other than
crypto.
Yeah.
Okay, does it work?
Let's see. Okay, let's go through the time frame, sir. Let's see what it is saying here. Yeah, so it's not calling any shorts at the moment. So that is a problem. That's definitely saying that through these trends. There's still a lot of resistance, sir. I don't know which trend you took. You obviously took the one at the top, but if you take this one over here, more touch trend lines are more powerful, and there's a trend line.
Let's just get let's get our trend lines looking the same. What am I doing wrong here? That's the trend line, right?
Okay, so go to you're on the daily, right?
I'm on the daily.
So go down, take the trend line lower.
You're saying from
get
here.
More touches. So go down. Yeah. So take it down.
And then you're saying take it slightly up here.
Again. Yeah. So take it from the 19th July.
19 July. Okay.
Take it out there.
That's about right.
Yeah. And then it gives it the more, it's way more tight. That's a 5-touch trend line stronger. And it just gives it that bit of room. So before we panic, there is a bunch of resistance sitting in these areas here and obviously high up as well. So we mustn't panic too much if it breaks that trend that it's going to be end of the world just yet. But yes, I say short-term pullback and then a bounce. I'll say another 2%, and then I think the market starts to bounce, slowly recover again.
Nick, what are you thinking, sir?
Dominance drops.
Yeah, I'm thinking, I agree with the short-term pullback. I think that Bitcoin is inevitably going to go back up. I'm just not bullish on alts right now. And when I say I'm not bullish on alts, it's the lower cap alts. I mean, Solana's, the higher caps. I'm fine with them and I'm holding them, but for low cap alts, it's just looking worse and worse.
It's not the season.
I don't think so. Unfortunately,
it's not the season, bro. It's not it just isn't the season. Like, let's just call a spade a spade. My bags are basically Bitcoin, Sol, a little bit of ETH, and then all the I bought 𝗏𝗏𝗏 and all those beta ETH beta plays and stuff like that. That's basically what my bags look like.
Yeah, very similar to me. I got some 𝗏𝗏𝗏, I got a lot of ETH, Bitcoin, Sol, of course, but beyond that, I'm just really not touching low cap alts.
Sheldon, tell me about this. So just walk me through what the indicator is saying. Like, I can't believe you built, like this guy, Sheldon, he builds an indicator, doesn't tell me one word about this indicator, pulls the indicator out. I was watching his show today, pulls this indicator out. Oh, guys, I've basically built Sheldon in my pocket. I'm like, oh, bro, we see each other like every day. We speak like 5 times a day. You didn't tell me once that you're building Sheldon in your pocket.
You know what the problem is with myself, right?
Yeah.
I know I've been trading now the last couple of years. Is the different emotions, different days. I got 2 kids now. They don't sleep. I wake up in the morning. I don't see my lines the way I'm supposed to at times. Where this is just like, you know, it's got 4 different things inside of it that all tick together. It's got invisible trend lines. It's got everything. So you'll see that when RSI is at the bottom, when it's at support, when a trend line is breaking, and multiple things are going through, then it calls a buy signal, and then it puts a stop loss in for you. And you can see over here, it tells you what's available. It's telling you right now, don't rush into anything right now.
So why don't you let anybody else use it? It's basically you got all your TPs. You got why don't you, bro, sell it, license it.
Let me enjoy it. Let me enjoy it. Let me make sure that I'm incredibly happy, and then we could maybe talk about it.
I don't know, bro. Okay, I give up. Okay, so
I'll give it to you, but don't share it, huh?
Yeah, but trading
view account yet, and then I'll give it to you. Don't share it.
Okay, so I'll give you my trading view account, and Nick also wants it. I can see Nick's also looking. He's eyeing this.
Yeah, well, what's cool about this is you can go to any time frame. If it's 5 minute, 50 minute, 1 hour, 4 hour, and it'll tell you exactly
I've been learning to do
what's
my own
in buy
indicators
zones, what's in
lately,
short
so
zones,
it's
gives
fun,
you stop
but
losses, gives
nothing
you
disadvantage.
But hold on,
does
Nick, 1
everything.
sec. Sheldon's still talking. Sorry, I know. Hardest, we've got to fix this tomorrow, bro. Okay. That's all good. All right, Sheldon. So you were saying, Sheldon, sorry, bro, I cut you off.
Oh, no, all good. No, I was saying that what's amazing about this is you can pop to any time frame, any token. So you can go in over here, and you can set any tokens that you want. Okay, it can be stocks or crypto, anything like that, and then it will tell you on every time frame what's in a buy zone, what's in a sell. Like right now, it's telling you, hey, wait for a little bit lower. Your buys are going to be available.
I'm gonna text you. I'm gonna quickly text you my trading view, and you must just send me the. I want to actually.
You can go to any time frame, and it will give you trades, stop losses, take profits. It even updates your stop losses for you. You can set alerts. It does everything. Okay. So finally, bro, it's better. It's better to have a robot version of ourselves. You were saying the whole year we need to become AI robots. So that's what got me inspired. So.
Okay, so I got an idea, Sheldon. I got an idea. Don't give us the indicator. Don't give it to us. Okay, don't. Okay, fine. But except me, give it to me. But teach us all the things that you put in the indicator.
I will. So that's why the new school, sir. New school, I will show you every single thing that I put into this.
Wait, hold on a second. When is new school? When does new school start?
If we pop on here, it is in...
Hold on a second.
5 days.
Hold on, I'm quickly going to go here. I'll just put a link to the sniper school. Okay, wait, I see there is a link. There is a link. Amazing. Okay, hold on a second. Okay, so where hold on a second. Sniper school. Okay, hold on. So there is a link here to sniper school. Let me just click it here quickly so we can all see it. Hold on. Okay, so
so I'm going to teach the basics. Once we're through with the basics, then I teach them how to choose what coins and how much, give you a roadmap on how much money you want to make, and then I teach you how to automate it. And then you basically it trades for you every day. I'm busy with this is my one. I'm busy with that process, but this is going to be incredible.
Guys, if you want to sign up, there's a link below. If you want to sign up, there's a link. There's a link below. Sheldon will show you how he built his indicator, but he won't give you the indicator, but you can still see how he built it. Nick, what you thinking, sir?
It's hard to keep track. I'm listening to it on YouTube while trying to, and then I'm hearing double and everything. Really hard to keep track. It looks really cool, and I'm definitely going to join the school and check it out. I do like Sheldon's strategy. I've been following Sheldon for a while.
Sheldon knows how to make things simple, bro. He taught me how to trade simply. Trend line, RSI. He taught me simply. Just watch for the break of trend line.
There's a 1 hour buy here on Sol.
Hold on. Show me. 1 hour. So on the 1 hour time frame, there's a buy.
They just popped up there now.
Yes,
it's telling us.
It's the one that says L. It's the one that says
incoming.
So L means long. L means long. Green.
No, it's long. It says long. It says long. You'll see it if it's a close up, and then it's popped the stop in over there. So it's great. Gives you everything. It says there's a long building on Chainlink now as well.
Fuck, this indicator is it's fucking amazing. Anyway, guys, listen, I don't think.
Never mind. Yeah. No, then you'll see that once this breaks out and breaks the trend, you'll see how to update the stop loss for you.
Oh, wow.
Which is amazing. That's amazing, bro. This stuff just does it for you while you're not there.
But you can't have the indicator.
Run.
All right. Well, I'll join the next sniper school because I know you guys done this. This is a new sniper school. This is like the whole game plan and how to get your accounts and how to get the thing ready and all that, right?
Yes, it's a good one, sir. It's a good one.
All right, fam. Listen, it's been amazing. It was boring, but it was amazing to hang out with you guys. I'll see you guys tomorrow.
Why are you wearing that hat, bro?
Because Trump was also wearing that, so I figured I'd look. Yeah, you see, you weren't
I
here
don't
when
even had one of those.
you weren't here when Trump was talking and I was talking too, and we both had our hats on.
I like it. I like it.
All right, fam. We'll see you again tomorrow. Until then, fam, trade well. Sheldon, trade well for you too, bro, with your new indicator that no one else can have.
Thank you, sir.
No one can have it.
I appreciate it. Okay, bye.
Don't
sir.
understand it. Yeah, do you understand Sheldon's strategy with this indicator? Builds an indicator, no one can touch it. All right, see you tomorrow, guys.